Well, the markets have had an incredible run over the last year and a half, and here's the most revealing statistic: the market capitalization of stocks listed on the Bombay Stock Exchange. Let's just take a look at that jaw-dropping number. That number has increased by a whopping 46 lakh crore rupees just in the last 15 months. Look at the number of zeros out there. That is what the BSE has added in terms of total market capitalization in the last 15 months. So where should you put your money now? Should you position yourself at these record levels in the market? Here are some of the best fund managers of the country with their bets on the way forward.
The problem is that investors look at past returns.
Correct.
And when they look at past returns, clearly equities become the most attractive asset class based on past returns.
Correct.
So I think the best part of what has happened is that the company has managed to persuade investors to invest in more conservative products. I think that's an achievement, because I don't think that if I go back to the 2007 boom, bulk of the money at that point of time was coming in infrastructure funds, which were easily high beta funds at that point of time. So the fact that money is coming in more conservative products, I think, is an achievement of the entire investment industry.
Correct. Naren, I know, one big contraband for you this year was telecom. We've seen some bit of revival in the telecom space. Even from a government point of view, there are some supportive measures. We'll talk about telecom, of course, but largely from a contra point of view, you think now it's time to bet large caps and not mid cap and small caps?
See, actually, we have had that view for the last 1 year, and it's only in the last 3 months that it has played out.
Sure.
And it's only in the last 3 months we have clearly seen that large caps have outperformed mid caps significantly. But we have had this view for the last 1 year. We continue to have this view that large caps are better than mid caps. And we continue to have that view, and we've been having that view, I would say, for more than a year at this point of time.
So large caps could continue to surprise, Naren. In that case, do you think that this market could go through the kind of phase that we had at the start of the last bull market? Where the earnings, of course, took a lot of time to pick up, but the market moved on. I'm talking about the early part of the 2003 to 2007 phase. Could we go through a similar phase in our market?
See, I think market valuations are not where they were in 2003. They are clearly much more expensive than that. I do agree that earnings will come in the next few years, but we are not in 2003. And I would argue that what I have learned from all past bull markets is investors have to focus on asset allocation and not get carried away and invest only in the performing asset class.
There are 3 sectors where, valuations are quite reasonable in terms of their historical average. But of course, they are cheap because there are certain factors contributing to it. So today, within IT, pharma and PSU banking or corporate-focused private sector banks, you have an opportunity in terms of getting into stocks which are trading below their historical averages. But of course, they are cheap for a reason, and hence you need to be picking up stocks on a bottom-up basis. You need to picking up triggers in advance which will turn around these sectors or turn around these companies.
Private banks is a sector we still continue to like, as we've seen with some of the results so far. Some of the leading private banks, when the whole system loan growth is barely 5-6%, these banks are still growing at 20%. And with digitization coming through and a lot of these banks leading the way over there, you could see their market share gains accelerate even further. While the POC banks, on the other hand, they're still struggling with their legacy NPL problems or the capital issues. So I think they will continue to gain. So private banks still remain our top picks. We were negative at the start of the year, but now we've become more neutral to marginally positive, mainly because of the sharp underperformance of the sector. But I wouldn't say we're out and out bullish as yet. Yes, the downside is protected given the lot of capital restructuring or the share buybacks or the dividends which would come through. But the revenue growth is still elusive. So, but yeah, valuations are no longer as expensive. So we wouldn't be underweight anymore.
Well, top fund managers, they're on the road ahead. Now, foreign investors may not be tightening their purse strings anytime soon. CLSA expects the Nifty to add another 3,000 points in the near term. So that's the outlook there coming in from CLSA. But the optimism perhaps is not unanimous because UBS expects the market to correct by about 1,000 points as they believe that valuations are expensive at the moment. But it takes both sides to make the market. So that's the CLSA target, and this is the UBS target. Take a look.
Psychologically, it is a bit of a milestone and can cause some hesitation. But if you look at the setup for the Nifty, we still think that at a minimum, the breakout that we saw in April when the market cleared the 9,100 area still has more room to the upside, and we've got a minimum upside target of the 10,350 for that breakout. So while it may cause some short-term hesitation, we do think we'll punch through that and at least get up to the 10,350 area.
We do think the market is expensive currently, and we do think it's overshot to the upside. Local strategist, his target for the year end for India and the Nifty is actually 9,000 now. But his upside scenario, and we've been pushing up to upside scenarios across the EM all year, is more like 10,000. Seen 30% of the index gain this year contributed just by 5 technology stocks in Asia.
Well, that's Jeff Dennis of UBS. So it is a new record high as far as our markets are concerned. Will the rally continue? Will the momentum sustain? That's the big question. But we will be taking queries, questions, comments right here on CNBC TV 18 through the week. But for now, thanks very much for watching. Stay tuned to CNBC TV 18. The news will continue.